Welcome in. Today's video is a little different. No tickers, no market data, just the core idea behind everything this channel does, selling options, and why that approach has any edge at all. Start with a question. When somebody buys an option, what are they actually buying? Usually one of two things: protection, a put that pays off if their stock falls, or a lottery ticket, a cheap call that pays off big if a stock takes off. Either way, someone has to be on the other side of that trade. Someone has to sell it. That someone is running an insurance business, whether they think of it that way or not. And the insurance framing is the whole idea. An insurance company doesn't know which house will burn down this year. It doesn't need to. It needs the premiums it collects, added up across thousands of policies and many years, to be larger than the claims it pays out. Option sellers work the same way. Collect premium, over and over, across different positions and different months, and let the math of many small edges do the work. So where does the edge come from? 3 places. The first is called the volatility risk premium, and it's the big one. An option's price is mostly driven by implied volatility, the market's forecast of how much the stock is going to move. Here's the thing. Historically, that forecast has tended to run higher than the movement that actually shows up. Fear is overpriced. People pay up for protection the same way they pay up for insurance, because the pain of a loss feels bigger than the pleasure of a gain. The gap between the volatility that gets priced in and the volatility that actually arrives, that gap is the seller's paycheck. The second force is time decay. An option is a wasting asset. Every day that passes, a little of its time value evaporates, and that value flows from the buyer to the seller. Traders call it theta. When you own options, the calendar is your enemy. When you sell them, every quiet day is a small payday, and the decay isn't steady. It accelerates as expiration gets close, which matters for how these trades get managed. More on that in a moment. The third force is probability. Sellers don't sell at the money. They typically sell strikes out where the market is unlikely to go. Sell a put 1 standard deviation below the current price, and statistically it expires worthless about 84% of the time. Stack that with the volatility premium and the decay, and you have a business that wins often, wins small, and pays for itself with frequency rather than home runs. Now the catch, because there is one, and it's a big one. That same insurance company goes broke when a hurricane hits a coast where it wrote too many policies. Selling options carries tail risk. You collect many small premiums, and once in a while the market hands you a loss that's several times bigger than any single win. Those losses are not a malfunction. They are the business. The sellers who survive are not the ones who avoid losses. They're the ones who make sure no single loss, and no single month, can take them out. Which is why real premium selling is less a trading strategy and more a risk management system. The rules do the heavy lifting. Trade small, a few % of the account on any one position, so no single name matters too much. Spread positions across underlyings that don't all move together, because correlation is what turns a bad trade into a bad month. Sell when volatility is rich, when implied volatility is high relative to its own history, so you're being paid the most for the risk you take. Take profits early, around half of the maximum, instead of squeezing out the last dollar, and manage or close positions around 21 days to expiration, before the final weeks where the odds get wild and a winner can flip on one headline. Set your expectations accordingly. This is a grind, not a lottery. The edge is real but it's small, and like a casino's edge, it only shows up across hundreds of occurrences, never in any single trade. There will be losing trades, losing months, and drawdowns that test your patience. The strategy doesn't eliminate risk. It prices it, spreads it, and keeps it small enough to outlast. That's the foundation. Everything in the daily reports, the focus on implied volatility rank, the interest in rich premium, the caution about liquidity, flows from this one idea. Run the insurance company, don't buy the lottery tickets, and let time and probability do the compounding. This video is for information and entertainment only. Nothing here is financial advice or a recommendation to buy or sell any security. Options involve substantial risk and are not suitable for everyone. Do your own research and size your own risk.